Welcome to the deep dive. We've got a really compelling stack of sources here today, all sort of centering around money, which, can be a tricky topic.
It definitely can be.
We're going to look specifically at the stock market world, which sometimes feels confusing, but also get back to some basic ideas about personal finance.
Right, grounding it a bit.
Exactly.
Yeah.
And these insights, they're coming straight from the material you sent over. Our job today, really, is to dive into this stuff together.
Yeah, unpack it.
Pull out the important bits, make sense of concepts that might seem, complex.
Yeah.
We want you to feel genuinely clued in by the end.
Hopefully have a few of those aha moments.
Totally. We'll be looking at market crashes, these weird animal names they use,
Bulls and bears, yeah.
risky investments, and even really fundamental stuff like what even is money and how should we, handle it?
Sounds good. Where do we start?
Okay, so let's dive in. The sources kick things off with a scenario, kind of a dramatic one, that really shows you the sharp end of financial markets. It starts with someone having to give some pretty tough news to another person. There's this apology like, sorry to bother you, but it's clearly urgent. Bad news.
Right, you can feel the tension already. And what's the actual bad news?
The core problem is this. The stock market just took a huge plunge.
Okay, a huge plunge.
Yeah, and the immediate result mentioned is losing a lot of money.
That phrase, took a huge plunge, it really captures it, doesn't it? It's not just a gentle dip.
Yeah.
It implies a really steep, really fast drop in the market's value. Think of it like falling off a cliff rather than walking down a hill.
Right.
And when the whole market does that, it means the value of lots and lots of assets just plummeted. And like the scenario shows, that's not just abstract numbers.
No, it's hard.
It has real, tangible, often painful effects on people's money, their savings.
And the reaction in the scenario is exactly what you'd expect. Shock. Disbelief, really. The person getting the news just demands to know, what happened. Why? Why weren't their securities and investments okay?
And that key question.
Yeah, they ask why these investments weren't bringing in a profitable return.
That phrase, profitable return, gets right to the core of why people invest in the first place, doesn't it?
Absolutely. What does it actually mean, technically?
Well, basically, it's the expectation that the money you put in, it's going to grow. You'll get back more than you started with.
Gain, benefit, profit.
Exactly. Whether that's through, regular income payments, dividends from stocks, or interest from bonds, or because the thing you invested in just becomes worth more over time, that's the hope.
And securities and investments, that sounds quite broad.
It is broad. It's really just a catch-all term for any financial asset you might own. So yeah, stocks, which are pieces of ownership in a company.
Okay.
Bonds, which we'll probably get into more, are basically loans you make.
Right.
Mutual funds, where lots of people pool their money. All that kind of stuff falls under securities and investments.
So the shock in the story makes sense. They expected safety, growth.
Profit, yeah.
And instead, boom, big losses.
Precisely. The fundamental expectation was just completely shattered.
Okay, so let's dig into the why behind this trunge.
Right.
The sources actually point to specific things right away. These indicators used to explain what went wrong.
Right. The market measures.
First up, they mention NASDAQ.
NASDAQ. Yeah, the sources mention it's an acronym, apparently a very long one.
Oh, yeah. They joke about that National Association of Securities Dealers automated quotations.
Right, but the main thing, like the sources say, is that people often think of it as basically the American stock market, or a big part of it anyway.
So what does it actually track?
Well, it's a major stock exchange, famous for listing a lot of tech companies, growth companies, though it has others too now.
Okay.
When people talk about the NASDAQ falling, they usually mean the NASDAQ Composite Index. That index lumps together the performance of pretty much all the stocks traded on that exchange.
So it's a benchmark, like a measuring stick for that part of the market.
Exactly. Especially for the tech sector, it's a really widely watched indicator of health.
And the companies on NASDAQ, they're described as publicly traded companies. What does that mean for a company to be publicly traded?
Good question. It means that the company has decided to sell shares of ownership to, the public. Anyone, really.
Okay.
So instead of being owned privately by just the founders or a few investors, they offer these shares on a stock exchange like NASDAQ or the New York Stock Exchange.
Why would they do that?
Mainly to raise money. Lots of money, potentially. By selling shares, they get capital to grow the business, develop new products, whatever they need.
And for investors?
It means you or I could actually own a small piece of a huge company. The value of those shares then goes up or down based on how the company's doing, what's happening in its industry, the overall economy, lots of factors.
Got it. So NASDAQ is one big indicator. The sources mentioned another one right alongside it, the Dow Jones.
Ah, yes, the Dow.
It's described as showing how well some companies or some stock are doing.
That's a good, simple way to put it. The Dow Jones Industrial Average, that's its full name.
Industrial average? Does that mean it only tracks factories and stuff?
It used to, historically, yeah. But now, not really. It tracks 30 large, really well-known, established U.S. companies. The source mentions 50, which isn't quite right. It's 30, but the principle is the same.
Okay, so 30 big ones.
Yeah, big names across different sectors, tech, finance, healthcare, consumer goods, you name it.
And like NASDAQ, it acts as an indicator.
Exactly. It's seen as a kind of barometer for the overall health of the stock market, especially these big established companies.
So if the Dow goes up, things are generally looking good.
Generally, yes. It suggests confidence, maybe strong corporate profits. If it goes down or suffers, as the source puts it.
Like in the scenario.
Right. That signals broader worries about the economy or the market, and the fact that both NASDAQ and the Dow were hit in the scenario.
NASDAQ down 200 points, the Dow suffering.
Yeah. That tells you the plunge wasn't just isolated to one type of company, it was widespread. A broad market downturn.
Okay, this is where it gets really interesting, connecting these big market moves down to the individual. The dialogue brings up the investor's portfolio.
That's a portfolio.
What exactly is a portfolio in this financial world, and why does its value drop so dramatically when the market plunges?
Okay, so a portfolio, in investing terms, it's basically just the collection of all the financial assets you own.
So all my investments together.
Pretty much. Think of it like a basket holding all your different investments, so it could have stocks in it, maybe some bonds, maybe mutual funds, other things too.
The source used an analogy of a company's product portfolio.
Yeah, like all the different products a company sells. It's the same idea, a collection of various items. In finance, it's your collection of investments.
And the goal is usually diversification, spreading things out.
Often, yes. Holding different types of assets is a way to try and manage risk.
Cool.
But the key thing here is that the total value of your portfolio depends entirely on the value of everything inside it. So when the scenario drops that bombshell, our portfolio is worth half of what it was worth 1 week ago.
Yeah, that's brutal.
It means the combined value of all those stocks, bonds, whatever they held, just got slashed in half. Because the market plunged, the individual pieces lost value, and so the whole collection, the whole portfolio, lost value. Dramatically, in this case.
Wow. Okay, now the dialogue uses these amazing animal metaphors.
The bulls and the bears.
Yeah. Bull market, bear market. We're not talking about actual livestock on Wall Street, I assume.
Huh. Thankfully, no. Although that would be a sight. No, these are just really common ways to describe the overall mood or direction of the market.
So what's a bull market? The sources say it's growing very rapidly, very, very strong.
Exactly. A bull market is when prices are generally rising, people are feeling optimistic, confident, and they're buying.
Why a bull?
The image is supposed to be how a bull attacks, thrusting its horns upwards, so prices going up.
Huh?
The sources mention China's bull market as an example, likely talking about periods where their economy and market just took off, grew really fast.
Makes sense. So the opposite must be the bear market.
That's the one. A bear market is when prices are generally falling, pessimism is setting in, investors are nervous, maybe selling.
And the sources say it slows down, not really growing very good.
Right. The image here is often said to be a bear swiping its paws downwards, or, as the source nicely puts it, maybe like a bear going into hibernation.
Kind of sluggish, retreating.
Yeah, exactly. Slow, negative, inactive growth. Technically, a bear market is often defined as a drop of 20% or more from the market's recent peak.
Okay, 20%. That's significant.
It is. And that line from the scenario, we didn't expect a bull market to become a bear market all of a sudden.
Yeah, that really captures the shock.
It highlights just how quickly things can flip. That optimism can evaporate and the market can turn negative, sometimes very fast. Knowing if you're in a bull or bear environment really shapes how you might invest.
Got it. Okay, switching gears slightly, but still within the portfolio discussion. The sources mention bonds.
Bonds.
Specifically, two types: high-yield trash bonds and government bonds. Let's start with just what is a bond?
Okay, so a bond, fundamentally the source says it's a promise.
I promise.
Yeah, it's basically an IOU. When you buy a bond, you're lending money to someone else. Could be a company, could be a government.
Okay, so I'm the lender.
Right. And the borrower, the bond issuer, promises to pay you back your original loan amount on a specific date in the future, that's the maturity date, and usually they also promise to pay you regular interest payments along the way.
Like rent on my money.
Kind of, yeah. It's the fee they pay for borrowing your money. So it's a debt instrument. You lend money, you get interest, and you hopefully get your principal back.
Okay. And they use the word yield with bonds. We heard profitable return earlier, but how does yield apply here?
Yield is basically the return you get from the bond. The source puts it simply, how much it gives, how much we are getting from it.
Like their orange tree example, yielding 300 oranges a year.
Exactly. That's the tree's output. Its yield. For a bond, the yield is essentially the income it generates for you, usually expressed as a percentage of its price. So a higher yield means potentially a bigger return on your investment.
Right. So putting it together, a bond is a loan you make, yield is the return you get. Now, trash bonds, the sources use that term, or junk bonds.
Yeah, trash bonds or junk bonds, not the most flattering names.
Doesn't sound great.
No. And as the source says, they are considered a very risky bond.
Risky how?
Risky because the company or entity issuing the bond is seen as having a higher chance of, well, not being able to pay you back. They might default on the interest payments or even on returning your original loan amount.
So why would anyone buy them? That sounds terrible.
Well, this is where the high yield part comes in. Because they are riskier.
You have to offer more return.
Exactly, the source nails it. Of course, since it's riskier, it has more yield. To convince investors to take on that extra risk, the risk that they might not get paid back, these bonds have to offer a much higher interest rate, a higher yield than safer bonds.
So it's a gamble almost. Higher potential reward for higher risk.
It's definitely a risk-reward trade-off. You could make a lot more money if the company does well and pays its debts, but you also stand a much bigger chance of losing your investment if they run into trouble.
And the sources mentioned government bonds too, presumably as a contrast.
Right. While the sources don't go deep into them, government bonds, especially from stable governments, are generally seen as much safer. Because they're backed by the government's ability to tax, the risk of default is considered very low.
And because they're safer.
They typically offer much lower yields than trash bonds. It perfectly illustrates that basic finance principle. Higher potential return usually comes with higher risk.
Okay, that makes sense. So let's imagine you're in that awful scenario, portfolio value cut in half. What do the sources suggest as ways to react strategically? Two phrases really stood out.
Okay, what were they?
The first one was to cut our losses.
Cut your losses. Yeah, that's a common one.
We hear it outside of finance too. But what does it mean specifically here, according to the sources?
It means deciding to stop something that's losing money to prevent it from losing even more. The sources say it's about trying to stop losing money somehow and suggest maybe sell early.
So accept the loss you've already taken and get out before it gets worse.
Pretty much. You draw a line, you say, okay, I've lost this much, but I'm not going to risk losing even more. You sell the investment, close the business, whatever it is, even though it hurts, to prevent further damage.
The source had that example. My business is failing. I'm going to cut my losses, sell the business, and start again.
Exactly. It's about damage control. Stop the bleeding, accept the hit, and move on or regroup. In the portfolio scenario, it might mean selling off some of the stocks that have fallen, even at a loss, if you think they might fall further.
And the sources then suggest using remaining assets, like maybe those bonds, to provide liquidity.
Right, liquidity.
That was needed to help cut our losses and then, interestingly, reinvest in emerging markets. Let's tackle liquidity first. Why is that so important in a crisis?
Liquidity, the sources say, is about having money, cash in hand. Ready money.
Available cash, not tied up.
Exactly. Available, not with credit. It's about how easily you can turn an asset into cash without losing value in the process. Cash itself is perfectly liquid.
And why is that crucial when the market's plunging?
Well, think about it. If everything's crashing, you might need cash quickly, maybe to pay bills, maybe to cover other losses. But strategically, having liquidity, having cash available, gives you options.
Like being able to sell something else easily.
Right. Selling a liquid asset like a stable bond might give you the cash needed to, say, cut losses on a riskier stock, or it gives you the firepower to potentially buy other assets that have suddenly become cheap during the downturn.
So you can take advantage of opportunities.
Potentially, yes. If you have no liquidity, you might be forced to sell things at the worst possible time just to raise cash, or you miss out on buying opportunities. So liquidity means flexibility and resilience, especially when things get volatile.
Okay. And then the suggestion was to reinvest that cash, that liquidity, in emerging markets. What are those?
The sources break down the word emerge, to come up, to rise, to come out.
So these are markets that are coming up.
Basically, yes. Emerging markets are the economies and stock markets of countries that are still developing but growing rapidly. They're moving from being less developed towards becoming more advanced economies.
The sources say they're new or growing markets, not established like, say, the US or UK.
Exactly. They're seen as new and exciting because they often have much higher potential for economic growth than the older, more mature markets.
Any examples given?
Yeah, the sources mention places like the Southeast Asian market or the West African market as examples. Think countries with fast-growing industries, maybe a rising middle class.
So potentially higher returns.
That's the attraction, yes. But, and this is important, they also tend to come with higher risks.
Like what?
Oh, things like political instability, maybe currency swings, the rules and regulations might be less developed. So suggesting reinvesting there after a big loss in established markets, that's a bold move.
A shift towards higher growth, but also accepting more risk.
Precisely. It's a strategic choice driven by the crisis.
And finally, the sources say this whole terrible situation might force the people involved to think outside the box. Love that phrase. What does it mean here?
Think outside the box. Yeah, it means get creative. The sources say, let's be creative. Let's try and discover new ways of doing things.
So not just sticking to the usual plan.
Especially when the usual plan just failed spectacularly. It means breaking away from your normal assumptions and routines. The sources say you might need to break some of the rules. Not laws, but maybe conventional thinking.
Don't just think the way that you always do.
Exactly. Do something new, be creative, come up with something great. When you've lost half your money, the old way clearly isn't working.
So you're forced to consider different, maybe unconventional strategies.
Right, like maybe shifting into those riskier but potentially faster growing emerging markets. It's about finding innovative solutions when faced with a major problem, adapting drastically.
Okay, so we've been deep in the weeds of market crashes and investment talk. But then the sources do something really interesting. They pull way back.
Shift perspective.
Yeah, to the absolute basics.
Yeah.
Like, what even is money? According to these sources, what's the fundamental definition?
It's really simple and clear in the sources. Money is something we use to buy things we need.
Food, clothes, houses.
All the essentials, yeah. Plus other goods and services we use. It's the tool, the medium of exchange that lets us get those things.
And how did we get to using money? There was a system before it, right? A long time ago.
Right. They talk about barter.
Barter. That's just swapping stuff.
Exactly. Direct exchanging things. You have something someone else wants, they have something you want, you trade. The source gives that classic example. A farmer who had apples could give them to a fisherman in exchange for fish.
Simple enough. But apparently it had problems. That's why money was needed.
Yeah, barter sounds simple, but it gets complicated fast. The main issue the source points out is needing a double coincidence of wants.
Meaning both people have to want what the other person has right then.
Exactly. The farmer needs fish and the fisherman needs apples. But what if, as the source says, the fisherman did not want apples that day?
Then no trade happens.
Right. It's inefficient. Plus, how do you trade half a cow? Or save up value if your apples rot? Barter has limits. Money solves a lot of those problems by being a universally accepted medium.
So once people realized they needed something better than barter, what did they start using as the very first money? It wasn't coins right away.
No, not at all. The sources give some really cool examples. In some places, people used salt as money.
Salt, really?
Yeah, because it was valuable for preserving food, for taste. It was useful and maybe scarce enough.
What else?
Elsewhere, precious metals like gold and silver were used for trade, obviously, because they were rare and desired. And some cultures used things like cowrie shells from the ocean.
Shells. Wow. So basically anything that a community agreed had value.
Pretty much. It needed to be somewhat durable, portable, divisible, and importantly, accepted by people within that group as having value.
So how did we get from salt and shells to the coins and paper money we mostly use now?
Practicality, mainly. The sources say coins were good because they were small, durable, easy to carry, and easy to count. Paper money was even lighter for larger amounts.
And crucially,
They became accepted by everyone, often because a government or ruler backed them, which built trust and made trade much easier over wider areas.
and the sources mention the evolution continues today.
Right, with bank cards and even online money, the form changes, but the function, being a trusted medium of exchange, stays the same.
Now, the sources make a funny but true point. People do not find money on trees.
Huh, if only.
So if it doesn't grow on trees, how do people actually get money today?
The main way, according to the sources, is pretty straightforward. Working at a job?
Putting in the hours?
Yeah.
Yeah.
Using your skills, your time, your labor, whether you work in offices, shops, schools, hospitals, and factories, and getting paid a wage or salary in return, that's the primary engine.
Any other ways mentioned?
They briefly mention receiving gifts. Sometimes family or friends might give you money, but the emphasis is really on earning it through work. It's something you acquire.
And because it takes effort to acquire, the sources really hammer home the idea of using it wisely.
Absolutely. Since it's not easy to get, you shouldn't just fritter it away.
So what are the specific tips for using money wisely, based on the sources?
They give some really solid, timeless advice. First, save money.
Put some aside.
Yeah. Keep some of what you earn, maybe in a bank or at home, specifically for the future. Having savings gives you security options.
Okay, save. What else?
Second, spend wisely. This means thinking about your priorities. Buy the important things first, like food, rent, and clothes. Needs before wants.
Makes sense.
Third, linked to that is avoid wasting money. Don't just buy stuff you do not need. Be mindful about your purchases.
Distinguish needs from wants again.
Exactly. And finally, there's a really nice point. Help others. If you find you have extra money after covering your needs and savings, you can use some to help people who are less fortunate.
It adds a different dimension to wise use.
It does. It frames money not just as a personal tool, but something that can have a positive impact beyond yourself.
And the sources contrast this with a habit they definitely don't recommend.
Right. They talk about people who spend their money very fast. They buy things they do not need, maybe impulsively.
And the result?
They end up with no money left. The sources explicitly say this is not a good habit. It leads to financial stress and insecurity. So this whole section really lays down the bedrock of sensible personal finance.
So money helps us get what we need, save for the future, even help others. It sounds pretty important. The sources explicitly say money is very important. Why that emphasis?
Well, based on what the sources say, it's important because it's the key that unlocks the necessities of life. It helps us buy the things we need to live: food, shelter, clothing, those basic survival needs.
It's more than just survival, right?
Yes. They also point out it helps people get an education, which opens doors. It helps people pay for healthcare, which is obviously vital. And ultimately, it helps people live a comfortable life, providing security and access to things that improve well-being.
Okay, so it's a powerful tool for living well. But then the sources immediately add a really crucial counterpoint.
Right. Money is important, but
It's not everything. What do the sources say is actually more important than money?
this is where the perspective really broadens. They highlight things that money simply can't buy, things with deeper value. First, good health.
Yeah, that's a big one.
The source puts it so powerfully. Without health, money is useless. Doesn't matter how rich you are, if you're too sick to enjoy it or even live, health comes first.
What else?
Second, family and friends. Those relationships, the love, the support, the connection. The sources say flat out, these cannot be bought. Their value is emotional, human, not monetary.
True. And the third thing?
Happiness. Real, true happiness. Money can buy comfort, distractions, experiences, sure, but the sources argue it cannot buy true happiness, which often comes from within, from purpose, from those relationships, not just from stuff.
So pulling that all together, what's a final takeaway on money's role?
The sources conclude that money is definitely very useful, even essential for navigating life, but it absolutely must be used wisely.
Back to those core principles.
Exactly. Save money, spend carefully, help others, use it as a tool responsibly, but always remember, as the sources state, while money makes life easier, the most important things in life are kindness, love, and happiness. It really puts finance in its proper place, doesn't it?
It really does. Okay, let's loop back then, connecting these fundamental ideas back to the stock market we started with. The sources revisit it near the end, tackling that question. Is investing in the stock market just gambling.
Right. They acknowledge that a lot of people see it that way.
Because it's risky, unpredictable.
Yeah, you can win big, you can lose big, seems like luck plays a part. So the comparison to gambling makes intuitive sense to many.
But the sources argue it's kind of like gambling, but not really. What's the crucial difference they point out?
The key distinction, according to the sources, is that successful stock market investing isn't supposed to rely purely on luck. It's meant to be about making calculated decisions.
Calculated decisions.
Yeah.
Based on what?
Based on information and analysis. That's why, as the sources mention, serious investors or professionals use all these formulas and all these different ratios and ways to ponder how much they should invest or what would they gain.
So they're studying companies, looking at numbers.
Exactly. Analyzing financial health, management quality, industry trends, economic conditions, trying to figure out what a company is really worth or where the market might be headed.
The sources call it almost a science, or even very much a science.
Right. Now, is it perfectly predictable? No way. There's always uncertainty, market psychology, unexpected events. But the process is supposed to be analytical, strategic, based on research, which is fundamentally different from just, say, rolling dice or betting on red or black. It's about managing risk based on evidence, not just pure chance.
And the sources mention that common ambition of playing the stock market, trying to buy stocks when they're low, wait until they're high, sell them off and make tons.
Yeah, the classic buy low, sell high strategy. And seen through this lens of calculated decisions, that whole effort is about analyzing risk.
Trying to figure out the odds.
In a way, yeah. People doing this, like the stockbrokers mentioned, are constantly weighing the potential upside, making tons, against the potential downside, losing your shirt. They use those formulas and ratios to try and assess the probability of prices moving up or down, understand the volatility, and manage the risk involved in trying to time the market.
Which brings us right back to the real-world impact. Because the sources make this really critical point. Brokers aren't just investing their own money. Often they're handling things like a group of workers' retirement funds.
And that changes everything, doesn't it? Suddenly, it's not just about abstract gains and losses, it's about people's futures, their security after they stop working.
The sources mention the kind of pitch brokers might give.
Yeah, highlighting potentially much higher returns, maybe throwing out numbers like 25% yield from the market, compared to maybe just 5% from a safe bank account. It sounds tempting.
But it highlights the huge trust people place in them.
Immense trust, and also the immense risk those retirement funds are potentially exposed to.
And the sources spell out the devastating consequences when things go wrong, linking back to that initial huge plunge.
Precisely. When the market tanks, like in the scenario, or like when the source mentions that bubble bursting in real estate and other areas a couple of years ago, stock prices can just collapse.
And the human cost.
The source is blunt and clear. All these people's retirement funds, the savings, they lost it. Just gone.
Wow. That really lands the point.
It makes it crystal clear why understanding this stuff matters. It's not just for Wall Street types. It affects ordinary people's lives profoundly. Their ability to retire comfortably, their financial security, it can all be on the line.
So the final advice from the sources on this is crucial.
Absolutely. It's simple, but vital. You got to be careful with this kind of stuff and do your homework. You can't just blindly chase high returns without understanding the risks. Diligence, awareness, caution, they're essential.
So what a journey through these sources you shared. We really covered a lot of ground.
We certainly did.
Started with that gut punch of a market crash. Figured out terms like NASDAQ, Dow Jones, portfolio, bull and bear markets. Even got into the weeds of bonds, like those risky trash bonds.
And looked at strategies for dealing with a crisis, cutting losses, needing liquidity, maybe even thinking outside the box with things like emerging markets.
Then we zoomed way out, back to basics. What is money? Where did it come from? Barter, SART, shells, and those core principles of using it wisely. Saving, spending carefully, avoiding waste, helping others.
And then we brought it back together, looking at the stock market again, not just as gambling, but as a place for calculated, if risky, decisions. And crucially, seeing the real human impact when those risks materialize, especially with retirement savings.
Yeah. Understanding all these concepts, even the basic ones about saving and spending, it really does empower you, doesn't it? And helps you sort of decode the financial world.
Definitely. It takes you from maybe feeling overwhelmed by all the jargon and numbers to actually getting it, having those aha moments you talked about. You start to understand what these terms mean for you, for the real world. You feel more informed, less intimidated.
And that was the whole point of this deep dive, tailored specifically for the material you provided. We really hope it's given you a clearer picture, maybe a bit of a shortcut to feeling more confident about these financial ideas. The sources ask that question. How do you use your money? Do you save it or spend it quickly? Maybe we can leave you with a thought that builds on everything we've discussed today.
Okay.
Consider this. How does really understanding the risk involved in markets side by side with the fundamental value of simple, wise money habits and appreciating those non-monetary things like health and happiness? How does all that together change the way you think about your own financial path or the choices you might make going forward?